Good afternoon. Let's talk about the two levers of financial independence today. Now, before we get properly into these two levers of financial independence, let's get some fundamental things in place. Let's understand the concept of building an asset portfolio. This is quite pivotal to you attaining financial independence at all. So let's understand the concept of building an asset portfolio. Your asset portfolio is essentially made up of rice. Yeah, I know. You heard me correctly. Rice. R-I-C-E. Rice. Like a bowl of rice? Yes. Now, rice, on a lighter note, is the asset categorization model that we use in Prism Check. So we use it to help people understand far complex things, things that are a bit more complex in the financial world. Using these acronyms help people really understand those complex things. Now, RICE is an acronym, as you could guess, where the R there stands for retirement or pension fund. The I stands for investment vehicles. The C stands for cash reserve. And the E stands for equity in your home. So that's what RICE stands for: retirement, investment, cash, and equity. Now, I've spoken extensively about this subject in other videos, so you can check out other videos to learn more about this. Now that we have that background understanding, let's get into the subject of today, the two levers of financial independence, which are referred to as TP. TP. T here is the first lever, which is time. Time. It's a measure of how long you can sustain yourself before you run out of cash. You were to lose your job or you were to lose your active employment. How long can you sustain yourself for before you run out of cash? So let's break it down. If your cost of living currently is £2,000 and in a savings account you've got £2,000 saved, that means your T or time is 30 days. So you only have 30 days before you run out of cash. Now, the C model or the C item from the RICE model is what we leverage on here. C, remember, stands for cash reserve. So we encourage people to maintain a cash reserve of up to 6 months of their living expenses. So we encourage you to maintain a cash reserve of a minimum of 6 months of your living expenses. So using that same example that I used earlier, £2,000 your cost of living. So we encourage you to have a minimum of £12,000 in your cash reserve, right? You can open an easy access savings account here in the UK, or you can even, if you want to protect your interest income from taxes, you can even open an ISA. An ISA is an individual savings account. It's a tax efficient way of saving. Okay, so you can open an ISA and you have an allowance of up to about £20,000 a year that you can save. And any income coming from that in terms of interest earned on that savings is completely tax-free. So if you're earning £20,000 on your ISA, the government will not take a dime from it. It's completely yours. So we encourage you, open an easy access account or an ISA where you can start saving towards this goal. This goal of £12,000 in that example, start saving towards it. It doesn't matter if all you can save right now is £200. Set the 12,000 as your goal and start saving towards it. That's your T. That's the first level of your financial independence. The second level of financial independence is the P. The P here is percentage. Percentage is the second level of your financial independence. So the question here is, what percentage of your cost of living can be covered from your portfolio income? What percentage of your cost of living can be covered from your portfolio income? So again, let's use the analogy of £2,000 a month. So £2,000 a month. Do you have any passive income that is up to £2,000 a month, or that is bringing in something that you can use in calculating the percentage of that £2,000 that you've got coming in as passive income? Now, again, going back to the RICE model, the items that we leverage on here is the I and the C. Remember, the I is investment vehicles. The C, again, is cash reserve. So if you've got £20,000 in your um, cash account or savings account, your ISA account, £2,000 in there, £20,000, and that is earning interest. So let's do a rough calculation. Let's assume that you can get up to 10%. I don't think you can get up to that, but just for easy calculation, let's assume you can get up to 10% of your 20,000. So 10% of 20,000 in a year is £2,000. £2,000. So you can earn £2,000 in a year from your cash deposit or cash reserve in that ISA account. Now, remember, using that same analogy of £2,000 a month as your cost of living, if you multiply that by 12, that's £24,000. So £24,000 is a target, but now your cash reserve is generating £2,000. So it's 24,000 is where we want to get to. You only have £2,000. So that's a bit far from there. That's less than 10%. So your P there will be about 8% of your target. Now, it's important for you to have an asset portfolio income. Make sure you build your asset portfolio so that you can start generating income from there. Now, for investment, there are about 3 categories of classes or asset classes under investment. You've got your business. So if you have a business which you have bought, could be a franchise or a business that you've bought or you run, and is operating as a business, not as another, not just a side hustle or another job. We're talking about proper business that can operate even if you're not there. So from that business, you can actually earn dividends. You can earn dividends from the business. So this will count towards a passive income or portfolio income. That is business asset. Then we have under investment, we've got appreciating asset. The most popular one is real estate, rental properties. So you can have properties where you put tenants in there or you're collecting rent. So rental income is another type of income or portfolio income that you can earn from your investment. And then the last class on that investment is risk assets. So if you've got stocks and shares, right, you can earn dividends because there's some stocks or some shares that actually you can gain dividend yields from them. So you can earn dividends as income. And also, if you're into crypto assets and you've learned about it and you maybe staking some coins and you're earning money from that, that can be income that you're earning. Or if you trade Forex, for example, you've got a Forex account that you're trading, maybe using robot to trade, you can earn profit from that as well. Okay, so those are portfolio income that you can get from your investment, either dividends from business asset or rent from appreciating assets or interest, profits, or dividends from risk asset. Okay, so in summary, we've talked about the RICE model, which you should focus on in building your asset portfolio. And we've also talked about the 2 levers, which was the main subject today, the 2 levers of financial independence, TP, time and percentage. They're very good in measuring your financial independence. So with these 2 key information that you've gained from us today, the RICE model and also TP, which are the 2 levels of financial independence, I trust that you can get on your way towards working towards your financial independence. In Prism Check, we have a fantastic tool that can help you. If you go to www.mygaphub.com, or you can scan the QR code at the end of this video to download the Finance app. This will help you to track your progress as you walk towards your financial independence. I wish you all the best. Till next time, remain on a smile. Bye for now.